The most powerful financial backer of the age of exploration never boarded a ship. It didn't navigate by the stars. It didn't cross the Atlantic. It didn't fire cannons or dig silver from mountains. And yet, it engineered the economic logic that made global empire possible. It was not a king, not a merchant, not even a nation state. It was an institution, the Catholic Church. And if you remove it from the equation, the modern world, politically, economically, and legally, looks unrecognizable. Welcome to Financial Historian, where money, power, and history collide, and the real story is always hiding behind the ledger. The myth of exploration. We inherit a cinematic fantasy. Brave explorers. Wind-filled sails. Unknown horizons. The age of exploration is framed as courage meeting curiosity. But that framing hides the core mechanism. Exploration was not a romantic adventure. It was capital deployed under radical uncertainty. And late 15th century Europe was economically fragile. The Black Death had not just killed millions, it shattered tax systems, destabilized feudal contracts, and hollowed out labor markets. Agricultural productivity fluctuated wildly. State revenues were inconsistent and often collateralized against future taxation. Wars between rival dynasties drained treasuries. Mercenary armies demanded payment regardless of outcome. Political legitimacy itself was unstable. Banking existed, particularly in Italian city-states, but credit was deeply personal and fragile. Defaults were common. Political risk premiums were enormous. Now imagine proposing this investment. A multi-year maritime expedition into unmapped waters. No reliable maps. No communication once departed. Unknown returns. Unknown geography. Unknown political resistance. From a financial standpoint, it bordered on irrationality. High capital expenditure. Extreme volatility. No liquidity. No insurance markets. This was venture capital without venture capital structures. Kings could fund prestige voyages. Merchants could gamble occasionally. But systematic global expansion required something far more powerful. An institution capable of stabilizing chaos. The church as a financial stabilizer. By the late Middle Ages, the Catholic Church was the most stable institution in Europe. It was the largest landowner. It operated courts across borders. It trained administrators. It preserved legal knowledge. It enforced moral doctrine. It outlived kings. It outlasted wars. It transcended national boundaries. If modern corporations seek regulatory clarity before investing, medieval Europe sought ecclesiastical clarity, because legality determined profitability. The church's greatest asset was not wealth, although it had plenty. Its greatest asset was the authority to define what was lawful, and law is the foundation of capital formation. Without enforceable property rights, investment stalls. Without recognized claims, conquest becomes piracy. Without legitimacy, violence cannot transform into ownership. This is where the church changed history. Engineering global property rights. The church did not need to fund voyages directly. It did something more transformative. It reduced legitimacy risk. In a fragmented Europe with no international arbitration system, papal decrees functioned as supranational rulings. When the Pope validated a territorial claim, Catholic monarchs were expected to recognize it. That expectation created predictability. Predictability lowers uncertainty. Lower uncertainty lowers the cost of capital. This is not theology. This is risk management. When the non-European world was divided by papal authority between Spain and Portugal, something revolutionary happened. Vast unknown territories were assigned legal ownership before they were even mapped. It was speculative jurisdiction. And it worked because all major Catholic powers accepted the referee. The Church had created a legal infrastructure for expansion. It transformed open-ended exploration into structured acquisition. Spain, Portugal, and the sacred investment model. Spain and Portugal became execution vehicles for this system. They had geographic positioning, maritime knowledge, and political alignment with Rome. But more importantly, they had institutional insurance. If a Spanish fleet conquered land across the Atlantic, the Church validated it. If Portugal established trading posts along Africa and into Asia, Rome reinforced the legitimacy. This dramatically altered expected returns. Investors, whether royal treasuries, noble financiers, or merchant backers, could calculate risk differently. Legitimacy was pre-approved. That meant future disputes were less likely to invalidate returns. The result? Extraction at unprecedented scale. Silver from the Americas reshaped global trade networks. Inflation surged across Europe in what historians call the price revolution. Capital flows intensified, but the Church's profit was not measured in bullion. It embedded itself into governance structures, missionary networks, tithes, land grants, ecclesiastical courts. It secured influence over inheritance, marriage, moral law, and education. In financial terms, it converted volatile frontier expansion into long-term jurisdictional control. Gold was temporary. Institutional authority was compounding. The compounding loop of empire. The model became self-reinforcing. Conquest justified conversion. Conversion legitimized governance. Governance normalized taxation. Taxation funded further conquest. The Church did not micromanage this loop. It designed a moral architecture that sustained it. And moral architecture is a powerful economic tool. If populations believe expansion is righteous, resistance weakens internally. If monarchs believe their claims are divinely sanctioned, coordination strengthens externally. Legitimacy is leverage, and leverage scales power faster than raw capital. The fracture when legitimacy breaks. Then came the rupture. The Protestant Reformation is often told as a theological revolt. Financially, it was a legitimacy crisis. When Northern European rulers rejected papal supremacy, they dismantled the Church's authorization monopoly. If Rome no longer defined lawful claims, then its global property system fractured. Papal boundaries became irrelevant outside Catholic space. And once consensus collapses, enforcement collapses. The referee had lost the room. This altered the financial calculus of expansion. Religious legitimacy no longer reduced risk universally. So markets innovated. The rise of corporate empire. The next wave of expansion did not rely on sacred decrees. It relied on charters. Joint stock companies pooled risk across investors. Shares allowed diversification. Legal personhood separated corporate liability from individual investors. This was a radical financial innovation. Instead of divine authority guaranteeing claims, contractual law did. Instead of papal bulls, there were state-issued charters. Instead of religious mandate, there was shareholder expectation. The Dutch East India Company became a sovereign entity in corporate form. It could wage war. It could sign treaties. It could govern territory. Not because God authorized it, but because capital and law did. England adopted similar models in North America. Colonization shifted from rapid extraction to settlement-based accumulation. Land ownership became the primary asset. Authority flowed upward from property holders rather than downward from centralized sacred hierarchy. Different financial structures produced different political cultures. Latin America versus North America. A funding difference. Why did Latin America develop centralized extraction states while North America developed decentralized property-based systems? Because their financing models differed. Latin America was built on church-sanctioned extraction rights. Authority centralized. Wealth flowed quickly to elites. North America lacked immediate extractable silver empires. Profit required time. Settlement. Agriculture. Land markets. Capital accumulated gradually. Neither system was morally superior. Both dispossessed indigenous populations. Both exploited labor. But their economic DNA differed. And funding models shape institutional outcomes for centuries. The quiet rebranding of exploration. By the late 17th century, the world was mapped. Exploration shifted from discovery to optimization, from claiming territory to managing supply chains, from sacred empire to corporate empire. Yet the core formula endured. Authority reduces risk. Reduced risk attracts capital. Capital transforms geography into asset classes. Modern global finance operates on the same logic. Institutions authorize risk they do not personally bear. They define legality. They construct narratives. They issue guarantees. The language is secular. The mechanism is ancient. The uncomfortable conclusion. The age of exploration was not primarily funded by bravery. It was funded by institutional control over legitimacy. When religion monopolized legitimacy, it financed empire. When religion lost that monopoly, markets assumed the role. The underlying architecture did not disappear. It evolved. The modern financial system, multinational corporations, sovereign debt markets, legal arbitration bodies, inherits this structure. Control legitimacy, lower risk, attract capital, reshape the world. The explorers may have sailed the ships, but the real investor was the institution that made their claims lawful. And history belongs not just to those who take risks, but to those who define which risks count.